November 2025. A transaction appears in LBMA clearing data that makes no sense. 650 million in silver. One buyer. One order. No public announcement. No press release. No explanation. Just a massive electronic transfer and 20 million ounces of physical silver quietly moving into allocated storage. That's not a trade. That's not speculation. That's strategic positioning by someone who knows something the market doesn't. And when I traced the pattern of these secret accumulations through history, I found the same sequence every single time. Quiet buying, months of silence, then a price explosion that leaves everyone else scrambling. Let me show you who's buying, why they're doing it now, and what happened the last 3 times institutions accumulated this aggressively right before a monetary reset. 650 million in silver. Let's put that number in context. At roughly 32 per ounce in November, that's approximately 20 million ounces. That's 622 metric tons of physical metal. To visualize that, you're looking at roughly 40 standard shipping containers packed with silver bars. That's not a position you take because you think silver might go up a few dollars. That's a position you take because you believe the entire pricing mechanism is about to break. Annual global silver mine production is around 830 million ounces. This single transaction represents 2.4 of 1 year's total global mine output. Imagine if someone walked into the global wheat market and bought 2.4 of the year's harvest in one purchase. Imagine if someone showed up to the oil market and said, "I'll take 2.4 of annual production right now, physical delivery." That's the scale we're talking about. And it happened quietly. No headlines. No CNBC alerts. Just data buried in clearing reports that most people never read. The LBMA, the London Bullion Market Association, processes these transactions. They publish aggregate data, but they don't name buyers. So we see the volume. We see the timestamp. We see the settlement terms. But we don't see who wrote the check. Except there's a problem with keeping secrets in financial markets. Money leaves traces, settlement patterns, custody arrangements, vault allocations. And when you cross-reference those patterns with known institutional behaviors, the mystery starts to narrow. This wasn't a hedge fund. Hedge funds don't take physical delivery of 622 tons. They trade paper contracts. This wasn't a mining company hedging production. They sell silver, they don't buy it. This wasn't a jewelry manufacturer. They buy in smaller, consistent amounts for production needs. This was someone with 3 specific characteristics. First, access to hundreds of millions in liquid capital. Second, infrastructure to store physical metal long-term. Third, a strategic reason to accumulate before a known event. That narrows the field dramatically. You're looking at central banks, sovereign wealth funds, or state-backed entities operating on behalf of governments. Now here's where history becomes your guide. Because this exact pattern, secret institutional accumulation followed by price explosion, has played out 3 times in the last 60 years. And every single time, the institutions positioning early made generational wealth while everyone else paid 3x to 5x more later. Let me walk you through them. 1965 to 1971. France and gold. Charles de Gaulle, president of France, didn't trust the dollar. He publicly questioned whether the US actually had the gold reserves to back the currency. But he didn't just complain. He acted. Quietly, systematically, France began converting dollars to gold. Not all at once. Gradually, they'd submit dollars to the US Treasury. The Treasury was obligated under Bretton Woods to exchange dollars for gold at 35 per ounce. France took delivery. They sent French warships across the Atlantic to collect the physical gold from the New York Federal Reserve and Fort Knox. Between 1965 and 1971, France accumulated hundreds of tons. No press releases. No announcements until after. Just quiet, relentless buying. Other countries noticed. Germany started doing the same. Switzerland followed. By 1971, the U.S. gold reserves were hemorrhaging. On August 15, 1971, President Nixon closed the gold window. He suspended dollar convertibility to gold. The Bretton Woods system collapsed overnight. What happened to gold? It went from 35 per ounce in 1971 to 850 per ounce by 1980. A 24x increase in less than a decade. France, Germany, Switzerland, the countries that accumulated quietly before the announcement, they were positioned. Everyone else paid exponentially more or got locked out entirely. 1999 to 2009. China and gold. In 1999, China officially reported gold reserves of 600 metric tons. For the entire decade of the 2000s, they reported the exact same number, 600 tons. Year after year, no change. The market assumed China wasn't buying. Then in April 2009, China makes a surprise announcement. Our actual gold reserves are 1,054 metric tons. They've been accumulating for a decade without reporting it. 454 tons acquired in complete silence. Why hide it? Because if the market knew China was buying aggressively, the price would have spiked, and they would have paid more for each subsequent purchase. By staying quiet, they accumulated during the entire bottom. Gold was 250 to 400 per ounce for most of the 2000s. By 2011, gold hit 1,900. China bought at the bottom, while everyone else chased the rally at the top. The pattern is identical to France. Quiet accumulation, public revelation, price explosion. 2006 to 2014. Russia and gold. After the 2008 financial crisis, Russia began aggressive de-dollarization. They started converting dollar reserves into gold. But just like China, they did it quietly. Monthly purchases, small enough not to move the market, consistent enough to build massive position. By 2014, Russia's gold reserves had tripled. Then came the Ukraine sanctions. The West froze Russian dollar assets, cut them off from SWIFT, attempted to strangle their economy financially. But Russia had gold, physical metal that couldn't be frozen or confiscated. The sanctions hurt, but Russia survived because they'd positioned years in advance. Gold went from 600 in 2008 to 1,800 by 2011. Russia accumulated during the dip and held through the spike. Once again, secret accumulation, public revelation, price explosion. 3 times. Same pattern. France before Nixon closed the gold window. China before the 2008 crisis. Russia before sanctions. Every time, institutions positioned before the public knew. Every time, they bought physical metal, not paper contracts. Every time, the price exploded after the secret became public. And now, in November 2025, someone just bought 650 million in physical silver. Which raises the question, who has that kind of capital, that kind of storage infrastructure, and that kind of strategic motivation right now? Let me show you the candidates. Entity 1, China's State Administration of Foreign Exchange. SAFE manages 3.2 trillion in foreign currency reserves. That's the largest sovereign wealth pool on Earth. For years, SAFE has been quietly diversifying out of U.S. treasuries. They've been buying gold. But recently, the focus shifted to silver. Why? Because China dominates global solar panel manufacturing. Over 80 of the world's solar panels are made in China. Each panel requires approximately 20 grams of silver. With 200 gigawatts of solar capacity planned for deployment in 2025 alone, China needs thousands of tons of silver. Not next year. Now, on January 1st, 2026, China implements export licensing on silver. Only state-approved companies can ship silver out of the country. That's 18 days from now. If you're the Chinese government and you know you're about to lock down domestic silver supply, what do you do in the months before? You secure as much foreign silver as possible. You buy from London, from Zurich, from New York. You move it into Chinese-controlled vaults before the export restrictions kick in and foreign buyers panic. The 650 million purchase fits perfectly. SAFE has the capital. They have the storage. They have the strategic motive. And the timing, November, 2 months before export controls, is exactly when you'd expect them to execute. Entity 2, India's Reserve Bank. India traditionally focuses on gold. But in 2025, something shifted. September 2025, an unusual order appears. 50 million ounces of silver purchased through LBMA intermediaries. India doesn't typically buy silver at that scale. Why now? 2 reasons. First, rupee diversification. India wants to reduce dollar dependence. But buying more gold is obvious and expensive. Silver offers similar monetary properties at a fraction of the cost. Second, electronics manufacturing. India is positioning as the alternative to China for tech manufacturing. Apple, Samsung, others are building factories in India. All require silver for components, circuit boards, connectors. If India wants to become the next manufacturing hub, they need to secure industrial metal supply chains. The Reserve Bank buying 50 million ounces in September, then potentially another 20 million in November. That's strategic industrial policy disguised as reserve diversification. Entity 3, Middle East Sovereign Wealth Funds. Abu Dhabi Investment Authority manages over 900 billion. Saudi Arabia's Public Investment Fund manages over 700 billion. These entities are transitioning from oil-dependent economies to diversified industrial economies. They're investing in solar, in electric vehicles, in technology. All silver-intensive. For the first time in their history, these funds are allocating 2 to 3 of portfolios to physical silver. Not gold. Silver. Why? Because they see the same math everyone else sees. Supply deficit. Industrial demand mandated by government policy worldwide. Price suppression through paper markets that can't last. A 2 allocation of a 900 billion fund is 18 billion. If they're building that position over 12 months, you're looking at 1.5 billion per month. A 650 million single transaction fits easily within that accumulation strategy. Entity 4, the wild card. What if it's not a state entity? What if it's a coordinated group of billionaires who studied what the Hunt brothers did in 1980 and learned from their mistakes? The Hunts tried to corner silver with leverage. They borrowed heavily. When the price crashed, they went bankrupt. But what if someone tried the same strategy with no leverage? Just cash. No margin. No loans. Pure accumulation of physical metal into allocated storage that can't be touched by exchanges, can't be margin called, can't be confiscated. 650 million is pocket change for the top 50 billionaires globally. If 5 of them coordinated, that's 130 million each. Entirely feasible. And if they're reading the same supply deficit data, seeing the same Shanghai panic moves, watching the same COMEX inventory drain, they'd be positioning now before the paper market admits it can't deliver. So we have 4 candidates. China securing supply before export controls. India diversifying reserves and securing manufacturing inputs. Middle East sovereign funds transitioning post-oil economies. Or a private consortium of billionaires front-running the squeeze. Any of them could be the 650 million buyer. Or all of them are buying simultaneously, which would explain why silver has moved from 24 in January to over 62 by December despite every attempt to suppress it. Now here's the critical question. Why now? Why November 2025? What's the trigger that makes this the moment to deploy hundreds of millions into physical silver? 3 specific catalysts converging simultaneously. Catalyst 1. The supply deficit is no longer theoretical. It's confirmed by every major institution. The Silver Institute projects 117 million ounce shortfall in 2025. 5th consecutive year of deficit. Goldman Sachs, Deutsche Bank, Bank of America, all published reports confirming structural shortage. This isn't fringe analysis anymore. It's institutional consensus. When institutions agree on fundamentals, they position before the crowd. Catalyst 2. The paper market is breaking in real time. Shanghai's emergency margin hike. COMEX inventory at 15-year lows. Physical premiums in China hitting 8 to 10 per ounce over spot. These are not normal market conditions. These are symptoms of a system under extreme stress. The Hunt brothers pushed silver to 50 in 1980 and the COMEX changed the rules to stop them. But you can't change the rules when the shortage is real. You can't ban industrial buyers from demanding delivery. The paper market suppression mechanism that worked for 40 years is failing. Smart money sees this and gets physical before paper contracts become worthless promises. Catalyst 3. Monetary instability accelerating. U.S. national debt 36 trillion. Interest payments approaching 1 trillion annually. Fed cutting rates while inflation remains sticky. BRICS expanding, 9 countries now, 34 more considering membership. Saudi Arabia accepting yuan for oil. The dollar's reserve currency status eroding measurably. When fiat currencies destabilize, capital flows to hard assets. Gold, silver, commodities that can't be printed. We saw it in the 1970s after Nixon closed the gold window. We're seeing it again now. The 650 million buyer isn't gambling on silver going up a few dollars. They're positioning for a monetary regime change where physical metal becomes the only trusted store of value. Here's what happened after the previous secret accumulations. France accumulated gold 1965 to 1971. Gold went from 35 to 850, 24x in 9 years. China accumulated gold 1999 to 2009. Gold went from 250 to 1,900, 7.6x in 8 years. Russia accumulated gold 2006 to 2014. Gold went from 600 to 1,800, 3x in 5 years. Every time, the secret buyer positioned at the bottom. Every time, the public chased at the top. Every time, the early accumulator made generational wealth. Silver right now is at 62. The structural deficit says it should be at 100 minimum to balance supply and demand. Bank of America's public target is 65, but their private institutional notes reportedly discuss 100 to 125. If the paper market breaks, if COMEX faces delivery defaults, if physical premiums explode globally, we're not talking about 100. We're talking about 150, 200, wherever price has to go to pull supply back into the market. The 650 million buyer knows this. They're not buying at 62 hoping for 70. They're buying at 62 expecting 150 plus because they have information the public doesn't. They know the export controls are coming. They know the inventories are empty. They know the industrial demand is locked in by government mandates that won't change. So what does this mean for you? If institutions with access to the best data, the best analysts, the best information networks are deploying hundreds of millions into physical silver right now, what does that tell you about where this market is heading? They're not buying for a 10 return. They're positioning for a 2x to 3x move minimum. And they're doing it quietly before the public realizes physical supply is gone. The window to follow smart money is closing. Once the mainstream media starts covering the shortage, once your neighbors start talking about silver, once dealers are sold out and premiums are 20 over spot, the opportunity is over. You'll be paying 150 for metal that institutional buyers secured at 30, 40, 50. The pattern from history is clear. Secret accumulation happens first. Public revelation happens second. Price explosion happens third. We're between step 1 and step 2 right now. The secret buyers are accumulating. The revelation hasn't happened yet. But when it does, when someone announces they've been buying for months, when the market realizes how much metal has already been locked away, the scramble begins. And by then, it's too late. Subscribe if you want to follow who else is buying and why the smart money is moving before the public knows. Because the 650 million buyer isn't alone. They're just the one we can see in the data. The question isn't whether silver is going higher. The math guarantees it. The question is whether you're positioned with the secret buyers or chasing with the crowd.